Hey there, everyone. Welcome to my channel. My name is Ryan Schul. In the narrative today, I want to talk about factor-based stock selection. Okay, so what is this and why would we even be interested in doing this? Basically, to capture persistent risks and understand which factors are likely to drive momentum or profits, and how do we quantify this? How do we qualify this, right? So we'll take a look at that in just a minute. Transparency and discipline, that's a big one too, right? Rather than chasing narratives or chasing trends and saying, oh, well, I think this is going to happen. I think that's going to happen. Perfect example, Tesla is the future, right? Who knows? Who knows if that's the future or not, right? It could be like chasing the wind. Diversification of drivers. So understanding factors that represent different styles of investing, that's important as well. Performance attribution. So what attributes drive the performance of your portfolio, right? Understanding that and being able to ask questions, because that is going to determine profits, value, growth of the portfolio, things such as this. Benchmarking and replication, that's a big one too, right? Many institutional managers, mutual funds, hedge funds say that they're alpha this and alpha that, but are they really, right? If you peel back the layers of the onion a little bit, you can really figure out what's going on there, right? And this type of analysis, factor-based stock selection, is going to help us make these determinations, right? And another big one is risk control. So factors help explain risks, and that helps us manage the risk, right? You can't manage what you don't understand. And there's probably a few other reasons too, but those are the big ones, I think. So let's jump into it. I like this website a lot. I'm going to get the fundamental data from here. So this is what the site looks like. I'll take you to the link. Control C, Control V. Okay, AAPL. So here's Apple, right? I think everybody knows what this is. These are the fundamental factors. Now I'm looking at a black screen with a very light, dark brown background here out my window. So it's a little hard to see, but I think, oh, that's a little bit better for me at least. Okay, so let me get rid of this ad popping up here, and let me get rid of that one. Maybe I can't. Now my highlights are gone. That's nice. Okay. Okay, so this is a little bit easier to read. So we have market cap, income, sales, cash flow, dividends, PEG ratios, price to sales, price to book, price to cash flow, EPS, TTM, right? So we have a lot of fundamental factors here, at least 70. Short floats, short ratios, ROA, ROE, what else? You can see them, right? There's all 70 here. So that's what we want to capture. We want to understand, and this is just a snapshot. I'll show you why this is a good approach, but there's really a better approach, but I don't have time series fundamental analysis. All I have is this snapshot in time. So I'm just going to work with this. If we could find that time series data, or I guess if you come here once a month and you had enough discipline, you could build up your own time series, right? But we can still do a pretty deep dive and pretty good fundamental analysis based on what we have. But I'll show you at the end how it could be just tweaked just to make it slightly better. So I have a list of stocks right here. These are all my tickers. I'm going to loop through each one, go to that URL that I just showed you, input that stock ticker to get all of the fundamental information for that stock, and then fetch it back into a data frame. Okay, so if I run this, Control Enter to run, you can see it's making a request to the website, and it's scraping these tickers right here. Okay, so when we are all done, we should have 30 tickers with about 70 or so fundamental factors, right? Or features, or financial ratios are called different things, right? In the data science world, it would be called a feature. In the finance world, it's called a ratio, right? So let's take a look, see what we have down here. Okay, so this looks good. And we have the index is just the list of tickers, and then we have all the fundamental features over here to the right. And if we just look at one, we go back and look at one. What's the first one? Amazon, AMZN. If I go back to AMZN, enter. So I'm gonna have to go to my trick over here because my background is so light, it's hard to see the stuff. Let me just pick out one or two. I see PE 33.83. And here 33.82. I think it's rounding something. That's fine. Let me just look at one more over here. Go to the end. If the first one is fine, then the last one is fine, then they're all fine. Okay, change. I see change 0.94 negative, 0.94% negative. Let me look for change. Change is down here. 0.9 7% negative. I think there's a little rounding issue going on or something like that. Let me look at one more. Volume 21069,764 volume. Give me volume. And I don't know where that was. 21100,744. 21100. These numbers are off a little bit, so there might be a lag in the way that the data is being pulled from here. I'm just seeing this for the first time because I did this many times and it was pretty accurate, although I have seen slight deltas here over time. The way it's being pulled using this user agent might be just slightly different than what we are seeing displayed on the screen here. I'm sure they're using some kind of JavaScript, so that might have some kind of impact too, or the numbers might be displayed slightly different here than they are using this headers method right here to get the headers, but it's pretty close and the fundamentals look pretty accurate, so I'm just going to go with it. Okay, so we can start the factor-based selection process right now. I have to map all of these fundamental features that you see here. Okay, so the price to earnings, earnings per share, trailing 12 months, insider zones, shares outstanding, performance week, market cap, all this. So I have to take all these fundamental features. It works nice in the data frame. It looks great to us, right? We can create a narrative around this and communicate a message to the top leaders of the enterprise that we're working with. But to really do the factor-based analysis here, we really have to convert these features slightly and just go ahead and map them into a form that is more factor-based, right? So this is good to display, right? And for a person to look at it, but to do a factor-based analysis, we really have to do a little more preparation here and kind of just refine the data a little bit, if that makes sense. So that's what I'm doing in this step. So I'm just getting things just more straightened out, cleaned up a little bit. So K is thousands, M is millions. This is billions. Okay, we're just cleaning up the data, doing some refinement over here. And then over here, mapping these PEs to make sure that it's prepared for this factor-based analysis that we're doing. So we have PE, price to book, price to forward cash flow, price to sales, price to earnings growth, right? And just making sure everything is a flow. Everything should be a flow. These should be percentages. So ROA, ROE, ROIC are all percentages. These are percentages, right? We're trying to clean up the data and just make sure that it looks right. Because if you look closely at this, ROA, ROE, right there, it actually is a percent. So that's good. That's what we'd expect, and that's what we want to see. But just to make sure, we want to make doubly sure that everything is in the right form, okay? So we're making all the floats. A float is anything that could have a decimal place. So a float could be like, let me find a good example here. This could be a float right here, okay? So it has a decimal place. It's in billions, but 2363.66, I think that's what the number is. So anything with a decimal is a float. Anything with a percent is a percent. And we're just forcing everything to be into that that form, right? We want to be very strict here. It looks okay when we look at that view, but just to make doubly sure, we just want to make everything clean and nice and orderly, okay? So that's what this part is for. So I believe I just ran that. Let me do Control-Enter again just to make sure. And expect a ticker column named index from your printout. Okay, so what did it come back as? Oh, index is right there. So let me do this again. I'm not sure what the problem was. Let me rerun this because I did this earlier and you can see that it was working before. So let me try this again and see what this does. Okay, give it a second to finish off. We're getting up to 30. Okay. Everything looks good. Control-Enter to run. Yeah, so I don't know what that last thing was. Some little quirky bug. Who knows? So that looks good. So let me just draw your attention to this. This is probably the most important part of this whole thing right here. We're creating an alpha score. This alpha score is basically just a formula that is handpicked with linear weights. This gets basically the weights of 4 factor signals. So we're looking at value, growth, quality, and risk. And we're just assigning a weight, and we're taking these 4, and you can see a plus signs, and combining them into one single score. So this is going to be alpha, right? If a asset manager or hedge fund manager says that they're seeking alpha, they're seeking the highest profit that they can based on the contents of the portfolio, right? You want positive alpha, you want positive return. Negative alpha is bad, and negative returns are bad, right? You want positive, more is better, right? So we're just picking these 4, value, growth, quality, and risk, and assigning that to our alpha score. Now, these can be other things. This could be ROA, this could be ROE, price to sales, price to book, something like that. I picked 4 here. I think these are 4 good features to start with, or signals to start with. There's many different ways you can do this, okay? I'm not saying this is the gospel, holy gospel truth. This is one way, and this totally makes sense. I think it's pretty common, pretty standard, but you can customize this so many different ways, right? You can have the price to book, ROA, ROE in there. It doesn't matter that much. I think it's really more of a personal preference, but this is a good first step. So I'm looking at value, growth, quality, and risk, and calling that my alpha score. Now, again, like I said a few minutes ago, really this is just a snapshot in time. We have these fundamental features, right? We have all these financial ratios, which is the same thing as the feature. And that is great. To really level up a little bit, you would really want a time series of these to see how it changes over time, right? Is the ROA growing over time, or is it being diminished? Is the ROE growing, or is it being diminished? What about price to cash flow, price to sales, right? Are these increasing? Are they decreasing? That is going to help you to determine, the movement of your alpha score and the movement of the portfolio, and like how you analyze these different stocks that we're looking at, right? And that is going to give you a better picture over a period of time rather than just at a single point in time. So if I could take this up a level, and I don't have access to this time series fundamental data, I know you can get it and you can pay a lot of money for it. I'm not going to pay any money. This is just a free demo, right? But I know that there's ways that you can get access to that, and that would make the analysis a little bit richer, a little bit more robust, okay? But I don't have access to that right now, and I looked around a little bit, I didn't see it, so I'm just going to go with this. But that would be one thing that I would like to see improved if I took this up to the next level, is to get a time series of fundamental factors. So you can see the alpha score over here, right? It's the addition of all these: value, growth, quality, and risk. And over here, value, growth, quality, and risk is the individual features. So value is positive 0.96. This is slightly negative. This is positive 0.39. This is 1.32. Add those together, you get that. So you can see the alpha score for MRK. MRK basically has the highest alpha score. So that is a very good starting point, okay? Now we have to pull in prices, and we want to look at the time series of these prices. So we're going to look at the change of these stocks over time. So we have the basis here. We have the foundation for our analysis, but we also have to pull in the prices and bake this into the whole thing that we're doing here. Okay, so I'm going to go to Yahoo Finance and pull in my prices right here. I'm going to go back in time 5 years. So number of days is 365 times 5. So this is 5 years of data. This is going to be the end date, and it's today. And we're going back in time 5 years. And we're also going to get in or pull in the SPY. This is the S&P 500 as a proxy. I want the proxy so I can see how well this portfolio is performing relative to an index that covers a wide span of the market, right? This is 500 different stocks. I have 30. I have the Dow 30. These are the stocks I pick. And by the way, you can change anything you want here. It doesn't have to be these 30, right? This can be anything you pick. And the time frame can be anything that you pick too, right? I'm looking at 5 years. I think that's a good start. It's a good place to kick off here. But again, is this absolutely the best way to do that? That's really a little bit more arbitrary. It's really up to you. You can go back further if you want. You can go back and just grab 3 years of data, right? If you want less data, you can get 3 years of data. I think 5 is good to start with. There is a little quirky thing because Yahoo Finance now uses a multi-index for all of their stock ticker column headers, right? This like this right here is Apple, Amgen, Amazon. So because I use this multi-index now, I think they switched over about a year or so. You have to pull that in, and you will have actually two SPYs. So for the S&P 500, you actually get two SPYs separated by a comma. That is like a little quirky thing that they do. So on our side, we have to take that and convert that into something that is useful, right? So we have to take everything that is multi-index, rejoin that, right? And then rename SPY, comma SPY to just SPY, okay? So if you comment out this line of code, you'll see what it's doing. I'm not going to do that. You can go ahead and try that if you want. It comes in a little bit funky. I like to clean it up and just make it look consistent with all these other things over here, okay? So that's why I added that in. So now we have a complete monthly factor score. These are the alpha scores that you saw before that are comprised of the four other scores, right? Those four fundamental features, and each month's scores, and we have this in a data frame, so that looks nice, right? Now this selection is not the historical backtest. Again, we don't have the historical fundamental features over time. All we have is this snapshot. So it's perfectly fine to experiment with today, and it's going to do what we tell it to do, and the performance is totally fine. But we would have a more accurate, more robust performance if we could see how these features are changing over time. So that would be nice to have. We don't have that. I wish we did. I could pay a lot of money and go get that, but I'm just doing this for free. It's just a free demo, guys. Okay, so top N is the top number of stocks that we want to pick when we get all of the rankings of all the features at the end. We're going to get the top 10. Anything that has a NAN, I did see a couple NANs in the data, so I controlled for that. At the end of the script, I'll show you how to do that because we can't calculate on a NAN. So there's a few reasons why you might have NANs. I'll get to that in just a minute. But we're just looking at the top N, but we might not actually have 10 if you have some NANs in the top 10 that are pulled back. I'll show you in a few minutes how that works. We're going to start with $1 million for this portfolio. The method is going to be equal weighting. You can use equal weighting or score weighting, doesn't matter. And the benchmark is going to be SPY. So I just put in a few parameters over here just to help us with the analysis when we get into it, right? And these are very fungible and very changeable. You can pick the top 30, right? You can pick the top 30 if you want. Now, some of these are going to have negative, are going to be assigned negative values. So you wouldn't pick the top 30 unless you're doing longs and shorts. I'll show you in a minute how that works, okay? Trying to juggle a lot of things here all at once. So if method is score, then we're going to do things a little bit different. I'm going to keep it equal weighted. Again, it's kind of arbitrary. It's really up to you what you want to do. I think equal weighting is fine. If you want to use the score method, you can assign different weights to all of the stocks that are added to your portfolio, okay? So I'm going to go ahead and remove any tickers that have bad prices or anything that has a NAN, right? Like I said before, sometimes we get NANs for a variety of reasons. I'll get into that in just a minute. Then we're going to go down here and create a buy list. Okay, so this data frame is going to consist of the alpha score. That's what we saw before. The weights for each of these stocks, it's going to be equal weighted. The last price, the allocation, the number of shares, and then the cost. So I want to create sort of like a scorecard here with the alpha scores, the weights, the prices for each of these, the number of shares we're going to have in the portfolio, and then the overall cost, right? And the cost is the price times the number of shares. So let me run this and you'll see the final printout and you'll see how this thing works. So Control Enter to run, and we end up with dropping tickers with invalid prices. So MRK, TRV, NVDA, and JPM have invalid prices, okay? And I'll get to that in just a second. The last rebalance was today. Today is August 21st, 2025, and we started with $1 million in capital. We are using $998,000. That's invested in cash. We have about $1,000 in cash. The alpha score here is 1.57. Better, higher is better here. Okay, that's the rule. This is 1.43, 0.88, 0.63, 0.05, 0.44, and a couple get dropped off. Okay, so valid prices. We have 6 valid prices. 1, 2, 3, 4, 5, 6. 4 got dropped, right? And these are the 4 that got dropped. Merck, TRV, NVIDIA, and JP Morgan. So I can actually pick more than 10. I can go ahead and get 15 and see what that looks like because we're dropping off 10. So now we have 15 were selected. We have 8 right here. My screen is a little bit hard to see. Okay. So I think I have Microsoft as a negative. I think I see a negative. Yeah, I do. Okay. So let me just add in just a couple more here. Let me get 20. Control Enter. So now we have a bigger list. We're still getting some with NANs, so those are getting dropped off, but this is fine. This will illustrate the point pretty nice. So again, higher is better with the alpha score 1.57. This is the best stock. We have shares 2012 total cost is 90871. And you can see that these are going to have equal weightings. So the weight is 0.009. So about 10% of the portfolio is allocated to each of these stocks, right? I'll go back to 10 in just a minute, but this is what I want to show you. If you see this negative sign, this is actually a stock that you want to short. So the way that I designed the script, we're going long only in my portfolio. I'm prevented from trading shorts. I cannot do that. The broker doesn't allow it. It's really a retirement account. It's not really a trading account. So you can't short anything. So I designed it just for longs. I think longs are safer. They're much safer, to tell you the truth. There was a story in the news a couple of years ago about, I think it was called Melvin Capital, that tried to short, what was that thing called? GameStop. And they got blown up and lost, I don't know how much, hundreds of millions in a couple of days because the shorts moved against these guys, so much so that they were hemorrhaging millions of dollars of cash, and they had to sell all their positions very quickly to get out of those contracts or those short positions. Melvin Capital. Sure, you guys heard about this story. It was all over the news. 2021, so that was 4 years ago, losing billions by shorting the stock before retail investors drove up its price significantly. The fund ultimately shut down in May 2022, liquidating its assets and returning cash to investors. As a financial strain from the event forced this, whatever that is, maybe that's the owner or something. Oh, yeah, I guess that was the owner, to step away from managing external capital. Okay, so that's my point. So shorts are very dangerous. I don't think I've ever done that in my life. I know how it works. You sell a stock at a certain price, you intend to buy it back at a lower price, but if the price moves against you, you get squeezed. It's called a short squeeze. And it could be called a short screw, I guess, because you get screwed pretty bad. And if you lose in that position, just like that little news snippet just showed you, you can lose billions in the blink of an eye. So that's very dangerous. If you were in a shorting position, or if you are into shorts, then you would look at negative alphas, right? Anything that has a negative alpha, the higher the better. If you're looking for shorts, right? If we look at all 30 of these, I can put up to 30. You can see what we get here. Now we're getting a lot of shorts. So this is the best thing to short: Bank of America, right? Or no, this is Boeing. But I always get those mixed up. BFA, it looks like BFA, but it's actually Boeing. That would be the next best, and this would be the third best. Walmart is a good short, I guess. But again, I'm not shorting, and the script above is specifically designed for longs only. It's not going longs and shorts. So let's get back to 10. Let's get back to business here and look at the top alphas. So these are the best. Again, we can't look at these because we're missing data for these, but Verizon is going to have the best alpha, APX, Goldman. This is the weight. Now we're looking at 16% of the portfolio. If you add this up, it's going to be 100%. These are the prices of the stocks. These are the number of shares. And the cost is shares times price. Okay, so that's how you get that. You can see you have more shares here because the price, or you have a lot more shares here because the price is lower. Here, the price is a lot higher, so you have fewer shares, right? So you have equal weighting. It's always 16%. If the price is higher, you buy fewer shares. If the price is lower, you buy more shares, okay? So that's pretty much it. That's it in a nutshell, guys. That's how you do factor-based stock selection. So the price screen guarantees that any and all NAND records are dropped. We can't do calculations on NANDs. That's just how these things work, right? NAND is a nothing, and it stands for not a number. It's not necessarily missing data. It's just nothing. It's not a zero, that's for sure. You can do a calculation on 0, 0, 0, but a NAND is nothing. So the reason why you could get NANDs includes basically incomplete final day, corporate action or corporate event, or maybe some data quirk. Ticker mapping issues could occur, holiday or non-trading mismatches or end of period slicing, something like that. There's a few reasons why you could get NANs. If you end up with an NAN, we just have to kick it out. There's nothing we can do with it, right? If we're running long only strategy like we are here, again, this is long only, we really only want the positive scores. I just showed you that. Anything with a negative is really designed to be a short. That's a good short opportunity, but we're not shorting here. And if we're running long short strategy, then you can use everything, right? So, but again, you're shorting the negatives, right? And you're going long the positives. So let me refresh this thing right here. I think we might be missing something at the end, or this could be the end of the notebook. Let me just refresh it and confirm. Okay, so go down here. And again, you can change the dates. You can change the stocks that you're looking at. That's very fungible. That's very changeable. No, this is actually the end. That's it, guys. So in a nutshell, that's how you do factor-based stock selection. The last thing I'll say is this is not investment advice by any means. Okay, this is mathematics. This is statistics. This is finance. This is computer science. A little bit of data science. What else? Capital market stuff, right? Asset management. It's not investment advice. So don't take this, don't take what I'm saying and just automatically do this. And then you accidentally lose some money and come back and try to sue me. Don't do that. Okay. Because I don't even have any money. It's not investment advice. It's just math, statistics, and finance. This is how things work. Okay. And again, this is a very common scenario. If you wanted to change those dates, go for it. If you want to change the tickers, go for it. If you want to change the number of stocks you look at, go for it. If you want to make this equal weighted or score weighted, go for it, right? There's a few different ways to do the analysis. So I'm not saying this has to be done this way. This is one way to do it, and this is a very realistic way to do it, okay? So I'm going to wrap it up here. Let me save the code. I will share all the code with you guys later. So HTML, I'll save that down, and I'll post the code. When I post the video, I'll do the video later. I'll pop it up onto YouTube a little bit later today, and you guys can check that out. Okay, so I'm going to wrap it up here. We are at, looks like 27 minutes. That's fine. We beat this horse to death. Mission accomplished. We did everything that we set out to do, so I'm pretty happy with it. Okay, thanks for your time. Thanks for sticking with it to the end to reach this point, and I'll see you guys in the next one. Goodbye for now.